En mild vinter kan rädda Europa från recession, men oron kommer ifrån amerikanskt håll längre fram. Med oss för att diskutera detta har vi Diggle joining us from Abrdn. You're an economist with Abrdn. It looks like the mild winter might be a trigger that evades a recession in Europe. I feel like a growing number of economists are signing up for that view. What's your outlook for Europe?
I think it's going to be basically zero growth over the winter, so that's much better than it could have been when 3-6 months ago a European recession looked almost guaranteed. Now mild weather, basically a complete round trip in European gas prices, big build up in storage. You've avoided having gas rationing in Europe over the winter. Consumers have more real income than they would have otherwise had, and you should now start getting a decline in headline inflation as well. It all adds up to, I think, now zero growth rather than negative, and the latest PMIs published in the last few days for the Eurozone show a return to basically 50, around the stagnation mark, but that's a big outperformance relative to a winter recession.
And a lot better than feared, of course. How about the US economy? Do you think that America can avoid a recession?
So the market seems to think so. A soft landing, I think, has become more of a consensus call in financial markets. I think that, unlike in Europe, that's a bit too optimistic at this stage. And actually a US recession, given the rate hiking cycle, given the need to deal with a very overheated labour market, seems pretty likely to me. And there, the data is actually confirming the further deterioration. So last year, weakness was only really concentrated in the housing market. Everything else was doing fine. December, January of this year, high frequency data is showing a further deterioration. So the PMIs, which are above 50 in Europe, are well below 50 in the US, consistent with contraction. You see weakness in retail sales, industrial production now as well. The one area of resilience is the labour market, but that's precisely the problem. The US has an overheated labour market, and our expectation, our view, is that a recession is what's needed to correct that overheating and really bring inflation down under control.
And speaking of inflation and the Fed trying to bring things back into control, the PCE data is very important for the Fed, due this Friday. Any thoughts on that?
I think you're going to see further downward shift in inflation in the US, and indeed that's a global trend now. Headline inflation is falling because energy base effects are turning very supportive. That it's such a large base of comparison that it can't but mean that headline falls. It's all about what happens to core inflation. Here the US has decent core goods disinflation. This is to do with easing global supply chains, the goods to services transition in consumer demand that's happening everywhere. But core services inflation in the US, particularly that generated by a sticky upward wage pressure, that's where the real action is going to be. Perhaps you're going to see some marginal improvement because medical services inflation is falling. Later in the year, shelter inflation is going to turn lower as well. But the labour market is still overheated. Wage growth, while moderating a little bit, is still well above inflation target levels. So yeah, the market's going to be encouraged by a little bit of a downshift in both headline and core inflation, but it's not happening quick enough to allow the Fed to pivot towards ending its rate hiking cycle, and that all means that probably recession has to cause that.
So if a non-pivoting Fed pushes the US economy into recession, can the European economy still avoid a recession? I understand that we might avoid it now due to the mild winter, but in the next phase with deteriorating American economy, what will that mean for us?
It's pretty hard for Europe to avoid a downturn in it's that huge trading partner, so there will be negative spillover effects. That's why for the year as a whole, I think Europe could still be a kind of stagnation to a mild down year. We've avoided the winter recession, like hurdle number one, but then there'll be the European spillovers. But remember, there are some big cross currents in the global economy. One is the US heading into recession in our expectation, but the others are reopening China, which is a boon, a tailwind for Europe, or at least those parts of Europe that benefit from tourist flows or Chinese industrial demand. So I think it all adds up to probably mild contraction later in the year in Europe. It's just very hard to decouple from a contracting US.
This Chinese energy, this Chinese hunger for minerals and raw materials will or might possibly fuel a new bout of inflational pressures in the rest of the world as well. Any thoughts on that?
You're already seeing a big surge in metals prices, in copper, in iron ore, in a lot of the raw materials that I think that's a play on China reopening. It's a bit less obvious in oil prices, but probably we don't get the deep fall in oil prices that you might otherwise expect during a US contraction, given China reopening. So yeah, that's one of the negative spillovers of China reopening. There are lots of positives, but for economies like the US where the problem is overheating, over demand, well, just adding a new source of demand to the global economy, an unleashed Chinese consumer, that's actually bad news for those economies whose problem in the first place is high inflation and overheating. So it does not offset or annul the US recession call. In fact, it perhaps makes it slightly more likely that the US has to contract. But there are such big downdrafts on inflation as well from energy base effects. Reopening China can't offset those entirely, but yeah, it slows down how quickly inflation is going to fall globally.
A lot of moving parts here. Any thoughts on how to invest in this environment?
It's a much more interesting year than I think 2022 was. Last year was kind of a sell everything year, higher inflation, higher interest rates, recession fears. This year is a global divergence year. Weaker US, stronger China, Europe somewhere in the middle but doing better than expected. Inflation high for now but coming down, interest rates still rising for now but potentially being cut later in the year once inflation moderates and some of those growth worries in the US set in. So I think that creates a lot of divergence. A few kind of top level asset takeaways for me would be duration looks quite attractive in that environment, in a kind of weaker growth in the US, lower inflation, eventual interest rate cuts. That should be good for duration.
Essentially long maturity bonds here.
Exactly. With rates falling, the price of bonds rises and rates are likely to decline later in the year. I think it's potentially a very good year for emerging markets, or at least those that benefit from China reopening. Parts of EM, like in Asia, where Chinese outbound tourists head, or in Latin America, which are commodity producers, or which are much closer to getting on top of their own inflation problems and cutting interest rates there as well. So an interesting year in parts of emerging markets. And then the final one would be the market is really positioned for a US soft landing. I've said, well, I think that's a bit over-optimistic, so that leaves me not particularly positive on parts of DM equity, parts of US equity markets.
So further downside risk on Wall Street, better to be in bonds, essentially.
That's right.
Wonderful to have you here in the studio, Paul Diggle.
Thank you very much.